Well, hello there, Dave. How are you today?
What a surprise, and welcome everybody to TCA Crossroads. This is a wonderful opportunity to look back at the year 2025. So, David, I'm going to drive this one if you don't mind, but we're going to have a good time seeing how, first of all, early stage fits into the entire investment picture. And there's some surprises. So, I'm going to ask you some things, but I'm going to tell you lots.
Well, I'm going to sit back, grab my popcorn, and enjoy this presentation as I always do. I'm looking forward to hearing from the foremost angel investor in the country, Mr. Berkus.
Yeah, bring on the slides. And I'll have to tell you, I'm not the foremost because you're going to see that General Catalyst has beat everybody. But you'll hear much more about that in a while. So, the summary of what we're going to talk about today, and these, by the way, have to be credited to CB Insights that produces this 4 times a year. And this is the fourth, which includes the entire year. You're going to get some real information here. I think it's going to surprise you. And there's some things that David talked about a few weeks ago that are very much incorporated in this, kind of by accident. And we had an argument last time, if you remember, David, about whether or not AI was first. We both agreed. And what was second? And I said it was robotics. And you're going to hear more about that too. So let's dive into this, and we will argue when the time comes and see if we can see who's right and what the data has to say. Here's a summary. First of all, the annual venture funding of $469 billion. I'll show you how we have been predicting in 2023 and 4 and early 2025 that 2025 would be the year. And in a way it is, but the information is split. So you'll hear more about that later. 48% venture funding for AI companies. We have been saying this. In fact, we've said it 2 or 3 times in the last several podcasts that we have handled. Robotics funding is the surprise, and that's the one where we'll spend some time, David, you and I. 40 billion into robotics funding, and 2 trillion, the value of the top 10 private companies. Skewed unbelievably. And if we have to teach people the difference between the mean and the median, we're going to have to do that today, because it is a number and a way in which we have to measure, which we didn't have to measure before until these mega deals came on. 213 deals from leading small venture capitalist companies, and that'll be something for us to talk about. So let's get into it and show you what we mean. Number one, the funding of $469 billion that I mentioned a minute ago, AI represents a monster piece of this. It dominates at 48% of all of the invested capital. Now, David said a couple of weeks ago that we follow, like Gretzky does, or did, the puck. And AI was the puck until right around the beginning of this year. And you're going to see some numbers that will be staggering as far as the kind of investment that has been made into AI by the big guys. But if the puck is moving forward, the puck is toward robotics and 5 of the other things that David mentioned in his last podcast. And so we'll have that conversation as well. Next, the US obviously dominates the global venture capital funding role. We knew that. But here's the way we look at it. So United States is 60% up year on year. So we are very right that it is the year 2025, as we predicted, that the numbers turn around. What we didn't predict is that the number of companies receiving money were fewer. We'll get down to that in a minute. And the number of dollars is more. That's why this mean and median conversation will be important. Asia's up a little bit, 7%. Europe is up 18%. But just look where we are, 60% more money in the US than last year. AI captured the 48%. And if we look at that one, turns out that if we look at the companies that got it, now we're beginning to hear this difference between the mean and the median. OpenAI received $41 billion worth of invested capital this year. Anthropic, $32 billion, and on and on. That kind of skews the entire relationship between how money and companies relate. And here is where David, several weeks ago, you and I argued about it. I'll stop and let you comment, but robotics, I said, was number two. And here is CB Insights agreeing with me. Robotics is the next frontier, reaching a record 40 billion in 2025. And companies we haven't really heard much about. We know about Boston Robotics, now owned by a Chinese company. Scale, Figure, these are companies we haven't been hearing about, and yet they're getting the most money. Scale got 14 billion. So I'm going to stop and let you absorb that, David, and tell me what you think now that we hear the argument and some data behind it.
I think what we have is a view of the elephant in different directions.
Good.
Because if I look at, and I don't disagree with the numbers, and I don't disagree with robotics as the next frontier in a variety of areas, because the way CB Insight cuts the data is different than the way I cut the data. I was looking at the technology, and they're, in a sense, looking at the application. But here's an interesting point for the viewing audience. Number one, this is VC. You're talking large company. When I was looking at skating with the puck, I'm not looking at the ice rink. That's the VC. I'm looking at the puck on that ice rink. I'm looking at the angel funding. So when I was providing that insight, I was looking at where angels would invest. And I'm just wondering if they follow that investment in the same way that the VCs do, because VCs are investing in the architecture like OpenAI, Anthropic, Scale, whereas AI is used as part and parcel of the businesses and the products that we in the angel community, the earlier stage companies, are looking at. So I don't think they're totally related. They leverage each other, but we don't buy the smaller piece of the larger puzzle.
And let me go on to say that, first of all, somebody has to be able to put the fulcrum in play, and that's the angel. And then somebody has to be able to take advantage of that fulcrum that has moved something. Yeah. And so this is what's happening right now. The funding, the angels have been playing with robotics for years, but never really getting much return. And here now, the real money is going into the big companies that are beginning to produce this at, and here's a little something, Scale, the company that got the 14 billion. So the physical AI model developers hold 4 of the top 10 highest momentum markets. I'm not going to spend much time with that, but as we've talked about in our podcast before, David, we have been playing with AI for doing things like due diligence. And it turns out that there are 2 ways we can look at AI. The developers that are the foundation. And here's the best chart to show just that. And then there is the agentic AI, the actual users of AI, the applications, the people that are going to be able to put it in place in the big corporations as well as the small companies. That's where the money's going to be. Just like when we first began to see mini computers, that was the way it went into small business for the very first time in an application. The first time we saw the internet, we saw tools all over the place. And then after a while, we began to see people using it to do commerce, to create things for their companies that they never were able to do before. Here's where we are today with AI. Any thoughts about that?
No, I just remember Ken Olson, and I remember the early days of the internet from my days in GSA and working with the DCA and DARPA. So and you're in the same, both of us are technologists, so I totally buy into what you're saying. But this is where the excitement is for me, actually. It still brings the energy to my body.
Me too. And I've invested in some AI companies. I actually manage one small one. So sure. So here is no surprise whatsoever. The rich get richer as valuations skyrocket in 2025. So look at the top. OpenAI. It started at a very high valuation. It got to $500 billion of valuation. And then the surprise might be ByteDance, because we don't see that in the United States as much as we might. It accounts for a lot of the Asian money that went in, but $480 billion valuation. And then we hear about SpaceX. Didn't increase its valuation much, but it didn't have to get to $400 billion. Anthropic did. Anthropic came out of nowhere, and it's 1,800% up which would be nice to have made that bet, huh?
Yeah.
Between 2022 and today at 350 billion, and on and on. You get the idea there. Leading
I just
investment.
one second. I just want to, ByteDance, I think, owns TikTok.
Yes, I know.
Yeah, so that's where the valuation has gone up, as that has just taken over for the younger generation social media.
As we record this, it was just this morning that it was announced that the deal was closed yesterday with mostly U.S. owners of TikTok, and ByteDance is now only 20%. We can get into that later, but that was a political rather than an economic decision. So leading investors bet all of their chips on AI? Yes, of course. I don't want to go into detail on this, except if you look at the top left, General Catalyst, 213 deals in AI. It happens that my deals from the beginning, going back to 1981, happened to total exactly 213. So I saw that number and I smiled. But this is deals in the recent years that just General Catalyst has done, and just in AI. Ouch. Followed by Andreessen Horowitz, followed by Sequoia and Excel. So the big guys are playing in AI. But remember Gretzky and the puck. This is what's happening today, not what they're thinking about tomorrow. Certainly not what the angels are thinking about tomorrow, because we have to be earlier to be able to, again, start that fulcrum moving. So global trends and investment trends. First, the annual equity funding and deals. I'll say it again, the number of funding, 469 billion, but the deals at 29,000 sounds like a small number, but actually this is worldwide, by the way. The number of deals is down, and you're going to see that in another slide. So quarterly, the funding turned in the fourth quarter of 2025. Well, because we have been predicting, as I said once before, that 2025 was going to be the year, and I began to wonder in quarters 1, 2, and 3. You can see them flat to the fourth quarter of 2024. And then suddenly in the fourth quarter of 2025, and again, it was big mega deals, I know, that made us actually having been a good prediction source. And where do they come from? US, 114 billion, nothing new there. The percent of quarterly deals will skip, because we're going to go, well, for a second, let's just go down to US at 39% of all deals in the world were done in the US, which is something to know. By investor group, this one is kind of interesting. If you look to the fourth one down, angels did 11% of all deals. Now, this isn't dollars, this is deals. We'll get to dollars in a few moments. VCs, no surprise, 31% of all deals. The average and median size of the deals. You remember what the average is? The average is, if you take the total of everything and you divide it by the number of deals, that's the average, or the mean. The median is you take the largest deal and go left and right from there. So this is median deal size. The largest deals are $24.7 million in size in this year. Look how much bigger they were, this average deal, than last year at 14. That's a massive change. And then if we look at the median deal size, which is something to know, is 3.3 million, the lower right black block. And we'll divide that into angels in a minute. I think you're going to want to hear that. What is the average deal size for angel investors too? So in the US, it's higher than in Asia, which comes next, and then on and on. No surprise there. The median deal size by investor group is the one we're going to talk about for a few seconds. On the left-hand side are the angel medium deal size. 3.4 million. That's a pretty big bite for angels. Certainly isn't what we see with the angel groups that you and I deal with, David. And so we have to talk about that. Is it syndication? Is it because individual super angels are changing that? Or is it these micro VCs that we heard in our last podcast? What do you think it is that's causing 3.4 million average deal size?
Yeah, I think you hit the nail on the head. I think it's a combination of what I've seen in the angel investing area, as well as the micro VCs or other investment groups, family offices, for example, I would think would be included in that area.
Mhm.
But over the years, when we first started, we saw the ask being something in the neighborhood of about $500,000. The asks now, how much money I want to raise, is going up 1.5 to lately I've seen $3, $4, $5 million ask. And then you flip it around, look at the valuations. The valuations are kind of starting, at $10 million for anything that says robotics and AI,
Yes.
or anything that has to do with precision medicine. So the median deal size doesn't shock me, because you're seeing a lot of high deals in certain areas, particularly in medical technology and robotics. Anything to get AI gets that bump, and then you're seeing everything else on the lower end being valuations more like we would expect. So it doesn't surprise me at all. This number is going up slightly, but if you look at it 20 years ago, that number would be extremely high, relatively speaking.
Right. So spend a few minutes looking at the 6 different classes here. One of the things we should be talking about on a future podcast is how has this industry, investment, private equity, changed over the last 25 years that you and I have been involved. And here is kind of a look at it right now. Angel investing, however you define it, is at the low end. Asset investment management, surprise, I had never thought of this as a class, but okay, is next to us, and the numbers are very much higher because the money available is higher. And then comes corporate venture capital, which was not really a big number during the last, or 20 years ago, during that period. And then corporations making investments into companies. And then private equity, which we've all known about as the very top from the beginning. But look at VCs. Right. Private equity exceeds VCs because the size of their deals is very much bigger, even though, again, the number of deals has been less. So if we have to give a crown to somebody, we're going to give it to private equity. Not as much as they spent in 2021. How many times do I have to say 2021 was the year? But I've got some deals working in 2026 and at the end of 2025 that we closed a few that we had no hope of closing in 2024. It's a good thing to know, but understand that VCs are still involved and they're still pushing money out, 8 billion or 8 million in their average size. And it's something for us to know. There are now 6 classes we'll talk about, more than the 5, because of this asset or investment management group kind of snuck in there as far as CB Insights says. So the annual mega round funding is the one that tells us again, 307 billion, look at the far right, 738 deals in 2025, $300 billion into just a few companies is kind of the way that we have to look at the world. Well, when was the last time this happened? How many times do we say it? 2021. We're back in the game again, but not quite the same way we were, but we're back in the game. Nice to say. Quarterly funding and deals for the mega rounds. This is the deals of over 100 million. Just kind of tells us that the fourth quarter was the quarter. We knew this already. The mega rounds come from the United States. No news there. So it's easy to be able to push beyond that one. So David, this kind of tells us, the slide that's on right now, the mega rounds are 73% of all deals. In other words, overwhelmed all the rest of us. And so we angels, as you see, are going to be a very small piece of all of this. And those mega rounds, once again, what were they? OpenAI and Anthropic and XAI. No surprise here. Just the numbers are shocking. What are the percent of deals by deal stage? Well, this might surprise you. Early stage, number of deals went down as number of deals went down in many stages, as we've talked about. And the early stage is 60% of all deals, although a tiny bit of all cash. So that's the thing we always know. The late stage, 10% of all deals, accounting for, what did we say? It was 60% of all cash. And the regional deal share, we're not going to spend much time except to say that the early stage deals in the US, the upper left hand, maroon, 35% of all early stage deals are in the US. That's kind of interesting because mid-stage deals are more, And then if we talk about large, mostly US still, but pretty equal around the world. And if we go to the early stage one more time, here is the number I wanted to show you first. This is by deal stage, and it's the funding amount now. Now, for the first time, we're not talking about number of deals. We'll talk about that again. So $2.4 million in the US in early stage deals. Mid-stage deals, 23 million, large stage deals, 27 million. So there's your number. 2.4 million is our mean average size. So the top seed deals, you won't recognize any of them. Isn't that fun? The biggest top seed deal was unconventional AI. Well, it is AI, but that was $500 million of funding dollars at the early stage. Now it is seed and angel, and you can define seed a little differently than we do, because seed can be defined as anywhere between $1 million and $5 million invested, and it can be a lot more. So it's a little hard to figure that one out. The top Series A deals, we won't spend much time on that, but you won't recognize those either. The ones we all recognize happen not even at the Series B. They begin to happen when we look at Series C, they're all AI again, and Series D, there's XAI as the top deal at $7.5 billion. This is Q4 now, and Q4 was the big quarter, as we remember. And the top E plus, now we're into deals that we don't even ever see. Anthropic, Lambda, these are all AI companies, and they're numbers 1 and 2. So headcount trends, that'll be interesting. If we look at the fast growing markets on year on year for headcount change, can you guess? AI web search and scrapers, more headcount by over double than last year. And AI web browsers, almost or more than double as well. AI interoperability, double, and on and on. We don't have to keep talking about that AI one more time. The annual share of M&A exits by number of employees. Look at this one. On the far right, lower side, less than 50 employees, 64% of all exits. Now that's interesting because my exits normally are companies that are well under 50 employees. Mm-hmm. A couple of years ago, I had an exit with 2,000 employees, but that's so rare that it's not even worth talking about. In other words, these early stage companies are exiting, but they're exiting with few employees. That's the number we're trying to give here. Quarterly deal count by number of employees. Well, same thing, under 50%, nothing to talk about. Total deals this last quarter, that's the fourth quarter, 2025, by valuation, by employee. That's kind of interesting. Let me set the stage for that really quick for you, David. The average number of dollars worth of revenue, not deals, revenue by employee, has crept up as lots of reasons have caused this, including inflation. It used to be about $125,000 per employee for the average company. Then it got to 150 and 175. So we're now at about $175,000 per employee for the average company. Doesn't mean the average company that gets investment, just the average company, average of the averages. Now look at the average amount of invested capital per employee, which is what this one is.
Incredible.
So pick one, pick Anthropic, which we all recognize as number 2, $131 million per employee. They had 2,600 employees. It doesn't matter. $131 million per employee. And here we are at the early stage again, distribution of deals by stage and headcount. So under 50 employees, 593 deals, early stage. And we see the number of deals in the early stage by employee count as the employee count increases, go across the top until you finally get to over 200 employees, only 7 deals. This last quarter, that is. But the quarter was the biggest quarter of all. So we're looking at early stage investing in very small companies. There's nothing new in that. Distribution of deals by commercial maturity and headcount this quarter. Well, emerging disappears. So if we're looking at maturity, which is a definition of anything that we don't do, there's none. And so we're talking only, again, about less than 50 employees. Unicorns, yeah, There are some more unicorns. In fact, there are 1,229 unicorns by count, and that's not a bad number. If we look at the new unicorns, which is what we should be kind of happy about, we had as TCA Fund 2 new unicorns during 2025. Well, there have only been 35 new unicorns in the last year, and most of them in the US. And so the new unicorns by global region, well, yes, most of them in the US, 28 of the 35. How about that? So it's nice to be an investor in the US, right, David?
Should be our, well, wish we can get all those unicorns. Figuring out which ones will be unicorns, of course, is the big holy, the golden holy grail, but that's what we're working on. Using AI to figure it out, by the way.
And yeah, and that'll be a past and a future webcast because there is so much information about that. And you're going to lead those. You led the past one, you're going to lead the one in the future, because it turns out that being able to analyze all these deals that come in front of us is a difficult task. And doing it manually required people to do research they weren't often willing to do. So we relied on a few experts that had opinions rather than facts. And now we're being led by facts, and it's kind of nice. And I'm going to let you lead that one because there's a lot more to say than you said even last time. So top unicorns by valuation, we don't want to care. I mean, they're always the same companies. So let's talk about exit trends and be done. The annual exits by M&A in this last year, in 2025, 10,466. By IPO, 549. Remember that train, the engine was stalled? Well, you see a slight uptick, right? From 440 in 2024 to 549 in 2025. SPACs have gone away, down to 40. So good riddance, SPACs. I didn't think much of them when they came out, and I don't think much of them today, and there isn't much to say about them anymore. Quarterly, the numbers are about the same. I mean, the percentages are about the same. And by global and region, 34% US, nothing more to say there. And the top M&As by exits, fourth quarter 2025, if you look down this list, you and I are not going to recognize any of them. And that's a surprise. But then again, I don't think you'll recognize the ones that I had this last year either. So the exits of these big companies whose names we recognize, they're already either public or they volunteer to stay private. So there isn't much more to say about those at all. IPOs in the fourth quarter, if you look at those again, we had none that really shine. I don't know what Meta X means, by the way. It's chips and semiconductors, so it's not the Meta you and I know. And SPACs, we're going to not talk about. And then finally, we're going to end with investors, a recap. So the biggest investors, Andreessen Horowitz, 46 deals in the fourth quarter. General Catalyst, 44 right behind it, and Excel. And then beyond that, companies that we know like Alumni, but not necessarily that we're big on. But look at Sequoia. Sequoia was the one that had the most activity 10 years ago. And now we've talked about how they've turned into an evergreen fund. They have fewer exits because they don't need to have a lot of exits. They can hang on to their deals. Their partners can hang on, buy and sell as they want, as if they were public shares. And so Sequoia probably doesn't feel the pressure to have as many deals as it had in the past.
Yeah, true.
And fourth quarter, same thing. And we're going to stop right here, David, because I think we have probably overloaded the viewer on these kind of statistics, and let you take the slides off and make some comments as you'd like.
Yeah, I mean, I think it's really interesting to see different perspectives. CB Insights is so good when it comes down to overall trends globally. Clearly, AI is the big elephant in the room. Didn't hear a lot, interestingly, about the robotics part of it, which I thought was quite interesting. So robotics, while it's really a big market space that's coming to fruition down the line, is still overwhelmed by the largesse of the AI market. But I just want to caution people, of course, I'll focus back upon the angels, and because that's what we invest in. when we invest in an AI company, we very rarely invest in the AI architecture. We're looking at AI models. We're looking at AI incorporated within the business. So it's part and parcel of the operations of that business. Very few companies that I know today are coming to us with saying, I have a new Anthropic, invest in us here. It's not happening. The big boys have to play in that space. Where I think AI will come into play, and it runs it hand in hand with two trends. Number one is robotics. We did see on one of your charts humanoids. It was towards the bottom of one of your graphs. And we've seen a variety of companies come in saying they have these humanoid and pet robotics for comfort toys or comfort, companions,
Right.
using AI, because the AI will parallel the emotional quotient of the person that it's trying to comfort. We'll also see AI becoming prolific when it comes into the general robotics area, and we'll see it very clearly in the precision medicine area as well. So we're seeing AI infiltrate all these market segments, which is really great.
Well
And
said.
that's the way I look at it going forward.
And it turns out that robotics wouldn't be robotics without AI. We have to say that.
Right.
So it's an important combination of technologies, and robotics wouldn't have been as big or the investments as much if AI hadn't already been available. And so it is really one that follows the other in that case. The same will be true with biotech. When we began playing with genetic engineering, we
That's
couldn't have
true.
done that without AI. And so
Right.
we are looking at major trends being influenced by other major trends. And if you talk about where we are today, I have often said that every 55 years we have game changers that are unbelievable, going back to the Industrial Revolution. 2024 and 25 are those years. And you may look back at this at 2030 and nod and say yes, but it'll be years again before we have something that will be as much of an influence on everybody's lives as was the internet, as
That's right.
was the minicomputer, as was the assembly line. Those things were.
Well, now you're really dating yourself,
I can go back further if you want, but the idea is every 55 years. Why would that be true? And why did it become true these last 2 years? It's something for us to talk about. It's a speech that I often give in a keynote, but it's one that surprises people, that it's so very predictable. David, I'm going to let you finish after all of these numbers and this discussion, but this was a good one.
I thought it was great, Dave. I really appreciate you going through the slides and giving a good retrospective from the CB Insights point of view on where technology is going, where the new technologies, new businesses are getting root. To me, looking at new technology, looking at growth, looking at these new applications make it exciting. And that's why I really will never retire from the business of trying to figure out which technologies are going to be the next great technology in which to invest.
Right,
It keeps me active. It keeps my brain active. I absolutely love it. That's why I'm part of the Angel Group at TCA.
Nice for you, and right back at you.
Well, with that in mind, I thank you, Dave. And this is David Friedman for Dave Berkus and TCA Crossroads. May your investing be great, and we'll catch up with you next time.